Hi, welcome back to Inspire Investing. Today we're going to be talking about what is a stock option and why do option traders trade options. So first, I want to go over the formal definition. I know there's going to be a lot of jargon and it might sound confusing, but then we're going to move into an analogy that can really connect everything and help you understand everything a lot better. So first, let's go over the formal definition of an option. So, what is an option? A stock option gives an investor the right, but not the obligation, to buy or sell 100 shares at an agreed upon price and date. So, let's try to understand this a bit clearer. So, right here, this is the investor. Let's say this is me, right? And I buy an option. When you buy an option, you are buying a contract. And this contract, what it says is I can either buy or sell 100 shares at an agreed upon price and date, depending on the type of option. So, an option can either give me the right to buy 100 shares of a certain stock at a certain date and at agreed upon price, or it's giving me the right to sell 100 shares at an agreed upon price and date. So, what are the two main stock options? So, the one that gives you the option to buy 100 shares is called a call option, also known as calls. And the one that gives you the right to sell 100 shares is called a put option, also known as puts. So I know this can sound very confusing, and this is the reason lots of beginners struggle to really grasp the concept of options. So a stock option, right? This contract I'm talking about, it is not the same as a stock. They are two different securities. They both have value. When you buy an option, remember you are quite literally buying the option to buy 100 shares of a certain stock, or you're buying the option to sell 100 shares of a certain stock. And there's a lot of characteristics that go with options, but I hope this analogy I'm about to cover next kind of connects everything and makes everything a lot more clear. So I want you to think as a stock option as a movie ticket. So let's say this is me right here. I'm the investor, I'm the trader, this is me, and this is my movie ticket. When you buy a movie ticket, you are buying the right to watch the movie at a certain time and date. But remember, you are not obligated to do so, meaning if you didn't want to go and watch the movie, you don't have to. So let's say this is my theater right here. I know it's not the best, just stay with me. So this is my movie theater. And when I buy this ticket, I am buying the right to go and watch the movie at a certain time and date. So if I didn't feel like going to the movie, because remember, I'm not obligated to go and watch it, I could go and sell my tickets to someone else for a higher or lower price depending on the demand and the popularity of the movie. So imagine you bought tickets in advance to go watch the midnight premiere of Star Wars, right? And when you finally get to the theater, there's a huge line to buy tickets, meaning there's a huge demand for the movie. So, what would happen if you showed up to the movie theater and you raised your ticket in the air and said, I don't want to go watch this movie. I want to sell my tickets. Who wants to buy my tickets? Most likely, someone will come up to you and buy those tickets off you at a higher price than what you bought them for. It's also important to emphasize that if you choose not to exercise your right to go and watch this movie, so if you choose not to go watch the movie or sell your ticket, like I just said, your tickets become worthless after the movie airs. So that kind of makes sense, right? Because you can't use the same ticket to go watch a movie after the movie airs. So let's go ahead and tie this in with the formal definition of an option. So let's go up here, grab our definition, and bring it down here so that we can see it. Get rid of this right here. Okay, cool. So, a right to buy the movie ticket. I mean, to go and watch the movie, right? We buy a movie ticket to go to have the option to go and buy and watch the movie. When we buy a stock option, our movie ticket becomes a contract. And this contract says that we have the option to buy or sell 100 shares at an agreed upon price and date. So, right here, let me highlight this right here. This would be what my option contract is letting me do, just like with the ticket, is letting you go watch the movie. So think of those definitions kind of equal to each other. And remember, this movie ticket or this movie has a certain date, right? You're going to go watch this midnight premiere Star Wars at midnight at a certain date. And an option contract has the same sort of deal. They have expiration dates. So this is what this date refers to. It is called the expiration date of an option, and is when the option contract is no longer valid and no longer allows you to exercise your right. Just like with the movie ticket, after the movie airs, we can no longer use the same ticket. Same concept applies. Excuse me. So right here, I want to point out as well, with an option, you are buying the option to buy or sell 100 shares at an agreed upon price. So what is this agreed upon price and what does it mean? This agreed upon price is called the strike price of the option, and it is the price specified in the contract that you are buying. And basically it tells you at which price that you are allowed to exercise your option at. So what does that mean? For example, let's say we have a call option with a strike price of $70, right? And let's say this call option is Apple. I know the prices are not perfect, it's just an example. So right here, with this call option, what it's saying is that we have the right to buy, because remember, call options give the right or the option to buy, put options give the option to sell. With a call option, for this call option, we are buying the option to buy 100 shares of Apple at $70. So remember, $70 is not how much you pay for the option, but is the price specified in the option that you are allowed to exercise your option at. I know that can sound a little bit confusing, so let's go over a put option. So let's say I buy the put option with a strike price of, let's say, $500 for Tesla. So in this case, remember, with put options, we are buying the option to sell 100 shares. So right here with this put option, I would be buying the option to sell 100 shares of Tesla at a price of $500 per share. So that's what that agreed upon price means, and that is your strike price. And remember, we talked about expiration dates as well. Just like with the movie ticket example, I have to go and watch the movie by or on the date the movie airs, because afterwards it is worthless. I can't use the same option or the same ticket to watch a movie. So we go down here. These two options expire on certain dates. And so when you buy an option, you will see that it has an expiration date or a date labeled by the option. So those are the dates that afterwards, on that end of that trading day, these options are you can no longer exercise these options after that date. So you can no longer buy 100 shares of Apple at this price at a $70 strike price, and you can no longer sell 100 shares of Tesla at $500. So next, let's talk about the options premium. So a premium is basically the value of your option. It is how much it's going to cost you to buy. So for example, as we looked here, a call option at $70 for Apple, right? This option to buy 100 shares at $70 isn't free, right? These options are not free. Just like with the movie ticket, right? You had to pay for this movie ticket. You had to pay for the right to go watch the movie at a certain time. Just like with options, you are going to pay for the option to buy 100 shares at a certain price at the strike price, like we talked about, the strike price right here, or you're buying the option to sell 100 shares at the strike price as well. Now this is called the premium, right? We have to pay for this option. As option traders, right? So if I trade options, I'm not really concerned with exercising my options, meaning I'm not concerned with buying or selling shares. Let me type this out. I'm not concerned with buying or selling shares. And if we switch to the movie ticket example, as an option trader, we would only be concerned with buying and reselling the ticket. We wouldn't really care about going and watching the movie. And so the same concept applies to options. So as option traders, we buy a call option or a put option depending if we think the price is going to go up or if it's going to go down. So with call options, we are looking for the price to go up. We are betting the stock price is going to go up. And that way, our premium or the value of this option is going to increase. So for example, let's say we buy a call option at $3. Now I want to point something out at first. So premiums are going to be priced per share for an option. And what that means is we have to recall back to the definition of an option. It is giving us the right to buy or sell 100 shares, right? So we are dealing with 100 shares. Now what happens if this call option is priced per share? Well, we have to take into account that we're dealing with 100 shares, so we have to multiply this premium by 100. This is also called the option multiplier. So we're going to have to multiply this premium by 100 to account for those 100 shares. And so we would end up paying a premium of $300. So in this case, we are paying $300 for this call option. And this call option is giving us the option to buy shares at a certain price by a certain expiration date, right? Okay, cool. So as an options trader, when I buy a call option, I'm betting that the stock price is going to go up. And what that means is all things equal, right? There's a lot of factors that can affect options, but all things equal, if the underlying stock price goes up, my premium will increase as well. And so let's talk about that. So as an options trader, we are basically buying and reselling premiums or options. So right here, I bought it at $300, right? I bought this call option at $3. So $300 is what I paid. So let's say the stock price goes up, the underlying stock price increases. All things equal, my premium is going to increase as well. So let's say that I bought it at $300 and now it's worth $600. At this point, I could sell my option for a profit. So if I would sell it now, I would have a profit of $300. This would be my profit, right? Because I bought it at $300, it went up to $600, so the difference between that would be a $300 profit. So if we go back to our movie ticket example, me buying the movie ticket, when I resold that ticket for a higher price and pocket the difference, that's what option traders look to do. They are not looking to go to the movie, or in other words, they're not looking to buy or sell 100 shares. They are solely looking to trade the premiums, the value of the option. So now let's look at put options, right? A put option gives an investor the option to sell shares at a certain price. So in this case, we would want the stock price to go down. So let's say our premium for this put option is $2, okay? So remember, we can't forget our option multiplier. An option deals with the right to buy or sell 100 shares. In this case, it's a put, so we are buying the option to sell 100 shares. And the premium is priced per share, so we must multiply this premium by 100 shares. That is our options multiplier. So we would end up paying $200 for the option to sell 100 shares at a certain price by a certain date. So recall our definition here, but we're not really concerned with buying or selling shares. We only want our premiums to increase in value. So if the price drops, right, all things equal, you will make money on this option. So what I mean by that is if the underlying stock price drops, your premium will increase in value. So the value of your option will increase. So we're going to look at that. So right here, you bought at $200, right? You bought this option at $200. Let's say it goes up to $800. At this point, you could sell your option for a profit of $600. So this would be your profit because remember you bought in at $200 and you sold at $800. The difference between those two would be a $600 profit. So this is how much you would earn. So why is this all important? And why do people even trade options in the first place over just trading equity, also known as just stock trading? So the first thing I want to point out is that options can have a higher percentage of return for smaller moves in the underlying stock. So I know that can sound confusing, so let's go over an example. So let's pretend you own one share of Apple, and that share is worth currently $107. So this is the price right now for one share of Apple that you own. So let's say Apple now goes up to $108, right? So a $1 gain. So your max profit, if you owned one share of Apple, that's all you owned, would be $1, right? Because the price of the stock or of the share went up $1, that's what you gain. With an option, however, if you owned an Apple call option, because remember with calls, we're betting the price is going to go up, and all things equal, we will make money if it does. So let's say you own an Apple call option, right? There's a lot more factors that goes into this, but I'm really keeping it simple right now. So an Apple call option with this $1 move, right? The stock price only increased $1, but with a call option, you can make up to, let's say, $50. You know, it's not uncommon for a call option to go up $50 with the $1 move in the underlying stock. So right here, it's not uncommon that this call option would have made $50 for this $1 move in the underlying stock. So in order to have this call option, right, you're going to have to pay a premium. So let's discuss that a bit further. So another thing I would like to point out, why we trade options over equity, or why people trade options in general, is that there's less capital needed to start than equity. And so let's talk about that. So equity is very capital intensive, meaning that you're going to need a lot more money or funds to make, significant returns. So less capital to start than equity. And remember, equity is stocks. So I want to give out an example. So let's say Facebook is trading at $100 per share. And let's say that one share, or the share price of Facebook, is now worth, or increases to $103, right? So a $3 increase in the share price of Facebook. So in order to make a $300 profit, let's say we're looking to make a $300 profit, we would need 100 shares of Facebook, right? Because 3 times 100 is a $300 gain. And 100 shares of Facebook, if it's currently trading, or if it was currently trading at $100, would be $10,000 that we would need to make this trade and make $300. Well, if you were trading options, it isn't uncommon for option traders to make that profit using less than $1,000 or maybe a bit more. It's all very dependent on risk, and there's a lot of factors involved. But just keeping it simple, you do not need anywhere near $10,000 to make that sort of gain. And that's the cool thing about options, is that it is not capital intensive. You don't need $10,000 to start trading options and have those types of returns. You could have made the same return off 1 or 2 contracts of call option contracts while trading options. So I hope this video was useful for you. I hope you guys learned something. Make sure, if you haven't already, and if you want to keep learning, to join my Discord. It is free to join. Follow me on TikTok, on Instagram, and subscribe to my YouTube if you are interested in more videos like this. And guys, always, if you have any questions, please don't hesitate to message me on Discord. I'm really about helping everybody, because I know how it was like to start trading options. I know how confusing it can be. So I really want to facilitate the learning process for y'all. And like always, guys, thank you so much for watching. I'll see you guys in the next one.